was April 15th, tax day, the date by which the majority of American households, businesses, and corporations were required to settle their obligations with the Internal Revenue Service. The checks were written, the electronic payments were submitted, the balances were transferred. And in a process that most Americans have never thought about, and most financial commentators rarely discuss, hundreds of billions of dollars were extracted from the banking system and moved into a single account at the Federal Reserve called the Treasury General Account. Yesterday, J.P. Morgan's head of short-term interest rates strategy, Teresa Ho, projected a withdrawal of approximately $400 billion during this period. The Treasury Department's own official guidance projected that the TGA could peak around $1,025 billion, plus or minus $50 billion, by late April. That is not a projection of normal seasonal flows. That is the largest tax drain in the history of the Treasury General Account system, happening right now over the next 7 to 10 business days, as the payments that were received on and before April 15th are processed, cleared, and moved to the government's account at the Federal Reserve. And the banking system that is absorbing this drain is not the banking system of a normal year. It is a banking system sitting on $306 billion in unrealized losses, 60 institutions on the FDIC problem list, a reverse repo facility that has been drained to near zero, and a set of macro conditions that include an oil shock above $100 per barrel, a naval blockade in the most important energy choke point on Earth, and the failure of peace talks between the United States and Iran 4 days before the tax deadline arrived. The combination is unprecedented. The liquidity trap that is about to unfold over the coming week is not a hypothetical scenario in a Fed stress test. It is the mechanical consequence of cash movements that are already in motion and cannot be reversed. And if you do not understand what happens to your bank account, when system-wide liquidity drains below the level at which short-term funding markets function normally, you are about to see it demonstrated in real time. This is the post-tax liquidity trap. And let me walk you through exactly what it is, why 2026 is uniquely dangerous, what signals to watch this week, and what it means for the money sitting in your checking account right now. The mechanism begins with a concept called bank reserves. When you make a tax payment from your checking account, your bank does not send physical dollars to the Treasury. What happens instead is an electronic settlement between your bank's reserve account at the Federal Reserve and the Treasury's general account at the Federal Reserve. Your bank's reserves decrease by the amount of your payment. The TGA increases by the same amount. The money does not enter the economy. It is removed from the banking system entirely and parked at the Fed. Until the Treasury spends it on government operations, that money is functionally withdrawn from the banking system's ability to lend, to fund repo transactions, to support market making, and to provide the liquidity that allows the financial system to function. Bank reserves currently stand at approximately $3.62 trillion, according to Teresa Ho's analysis. A $400 billion tax-related withdrawal would take reserves toward $3.2 trillion. That sounds like a large cushion. It is not. The critical threshold for what the Federal Reserve calls ample reserves is approximately $2.8 trillion, based on the repo stress that emerged in the fall of 2025, when the Fed was forced to conduct a $29.4 billion intervention to relieve funding market pressure. With reserves at $3.2 trillion heading into a period of elevated volatility, the cushion above the ample threshold is approximately $400 billion. And $400 billion is precisely what is about to be extracted by the tax payments that are clearing right now. Now let me show you why this tax drain is structurally different from every previous one, and why the September 2019 precedent that analysts keep referencing is both relevant and potentially understated as a comparison. In September 2019, a combination of corporate tax payments and large Treasury security settlements unexpectedly drained reserves to a level that the funding markets could not absorb. The overnight repo rate, which normally trades within a few basis points of the Federal Reserve's target policy rate, spiked from approximately 2% to as high as 10% overnight. Banks that needed to fund their Treasury positions overnight discovered that the market no longer had adequate cash supply at normal rates. The Federal Reserve was forced to intervene with emergency open market operations, injecting billions of dollars of liquidity to restore normal functioning. The episode was brief, but it revealed a structural weakness in the post-crisis financial system. When reserves fall below a certain threshold, even routine funding operations can seize without warning, and the damage can cascade through the entire financial system in hours rather than days. The 2019 episode happened with the reverse repo facility still active as a liquidity absorber. Money market funds and other institutions that had excess cash could park it at the Fed through the reverse repo window, earning the award rate. When the system needed cash, those institutions could withdraw their reverse repo balances, adding liquidity back into the system. The facility functioned as a pressure valve. In 2026, that pressure valve has been drained. The overnight reverse repurchase agreement facility, which at its peak held over $2 trillion, has been reduced to near zero. Bloomberg reported in September 2025 that the facility had dwindled to levels last seen before the pandemic. The safety mechanism that absorbed liquidity shocks in previous cycles is no longer available. Any additional pressure on cash markets now falls directly on reserves. And reserves, after the tax drain, will be at their lowest point in years. The Federal Reserve's New York branch has explicitly acknowledged this dynamic. In a speech delivered in late March, the New York Fed discussed its reliance on tools like the reserve demand elasticity monitoring, the secured overnight financing rate behavior relative to the interest on reserve balances rate, and the standing repo facility usage to monitor reserve adequacy as Treasury general account fluctuations create volatility. The standing repo facility is the Fed's mechanism for providing liquidity to eligible counterparties when overnight funding markets come under pressure. It is a pressure relief valve. And the New York Fed's own speech indicates that the Fed is expecting to use these tools more frequently as the year progresses because the traditional absorbers of liquidity shocks have been depleted. Here is the specific sequence that is likely to unfold over the coming week as the tax drain moves through the system. First, between April 16th and April 22nd, the payments that were submitted on or before April 15th will clear through the banking system. Each payment moves reserves out of the banking system and into the Treasury general account. The aggregate effect over this 7-day window could exceed $300 billion in net reserve reduction, depending on the actual size of tax receipts. Second, during the same period, the Treasury will continue its normal bill and note auctions, which require buyers. If Japanese institutions continue to reduce their purchases, as the Ministry of Finance data has documented, and if domestic buyers must absorb the additional supply, Treasury yields face upward pressure. Rising Treasury yields increase funding costs across the entire financial system. Third, quarter end is 11 weeks away on June 30th, but month-end effects are already building. Banks prepare for month-end balance sheet reporting by reducing their repo activity, which tightens market liquidity further. Fourth, overlaid on all of this is the ongoing stress from the Iran war, the naval blockade of the Strait of Hormuz, the oil price above $100 per barrel, and the bank earnings reports that are revealing the condition of the American consumer and commercial real estate in real time. The combination creates a funding environment where small disruptions can produce large consequences. If any one of these elements surprises to the downside, the others compound the impact. If Treasury yields rise sharply because of continued foreign selling, the unrealized losses on bank securities portfolios grow even larger, reducing bank capacity to absorb deposit withdrawals. If a regional bank experiences a deposit outflow it cannot fund from its reserves, it will need to borrow in the repo market. If the repo market is tight because of the tax drain, the bank will borrow at elevated rates, which compresses its net interest margin. If the margin compression is severe enough, the bank may need to sell securities at a loss to raise cash, which crystallizes the unrealized loss into a realized loss that hits the capital ratio. And when the capital ratio falls below regulatory minimums, the FDIC is required to act. This is not a theoretical chain. It is the exact sequence that produced Silicon Valley Bank's failure in March 2023. SVB was forced to sell Treasury and mortgage-backed securities to meet deposit withdrawals. The losses on those sales destroyed the bank's capital. The confidence crisis accelerated the deposit outflows. The bank failed within 48 hours. The Federal Reserve was forced to create the Bank Term Funding Program to contain the contagion. That program was closed in March 2024, but the underlying vulnerability that produced SVB's failure, large unrealized losses at banks combined with pressure on liquidity, has not been resolved. It has been amplified. The $306 billion in current unrealized losses is larger than it was when SVB failed. The 60 banks on the FDIC problem list represent more distributed vulnerability than the concentration at SVB, and the liquidity environment heading into the post-tax drain is more fragile than it was in March 2023. Now, let me tell you what signals to watch this week, because the early warning indicators of funding market stress appear in places that most retail investors do not monitor. The first signal is the secured overnight financing rate, or SOFR, relative to the interest on reserve balances rate. When reserves are ample, SOFR trades close to IORB with low volatility. When reserves become scarce, SOFR begins trading above IORB, reflecting the premium that banks are paying to access overnight funding. The spread between SOFR and IORB is the real-time measurement of whether the funding system is healthy or stressed. A widening spread signals tightening conditions, even when absolute reserve levels appear adequate. During the September 2019 episode, the spread blew out to unprecedented levels within hours. This week, watch the spread closely. The New York Fed publishes SOFR daily. Any sustained widening above historical norms is the leading indicator that funding pressure is building. The second signal is usage of the standing repo facility. The SRF is the Fed's ceiling mechanism for overnight rates. When banks find market-based repo rates higher than the SRF rate, they can borrow from the Fed directly. Occasional SRF usage is normal. Frequent or growing usage indicates that the market is no longer clearing at prevailing rates, and the Fed's backstop is being activated to prevent further disruption. If the daily SRF take-up numbers begin rising meaningfully over the coming week, it signals that the tax drain is producing exactly the kind of funding stress that the Fed was preparing for when it halted Treasury runoff in December. The third signal is the broader Treasury repo reference rates, the tri-party general collateral rate, and the broad general collateral rate. These rates reflect actual overnight funding costs in different segments of the repo market. If they diverge significantly from SOFR or from IORB, it indicates stress in specific corners of the market that could cascade. The Federal Reserve Bank of New York publishes all of these rates on its public website. The information is available to anyone who wants to monitor it. The fourth signal is money market fund government asset balances. The Guru Focus analysis documented that money market fund government fund assets decreased by approximately $10.3 billion in the week preceding the tax deadline, nearly double the outflow observed in the same week before last year's tax day. That outflow indicates that money market funds are being tapped by investors who need cash for tax payments. If the outflows continue accelerating in the days following April 15th, it suggests that the liquidity demands on money market funds are larger than historical norms, which in turn means more pressure on the underlying repo and Treasury bill markets that money market funds participate in. The fifth signal is the bank earnings themselves. Goldman Sachs reported April 13th. JP Morgan, Citigroup, and Wells Fargo reported April 14th. Morgan Stanley and Bank of America reported April 15th. The commentary from these institutions about their liquidity positions, their reserve balances, their commercial real estate provisions, and their expectations for the remainder of the year will provide the most direct insight into how the banking system is positioned to absorb the tax drain. If the major banks are expressing concern about credit quality, raising loan loss provisions, or signaling caution about commercial lending, the implications for the smaller institutions that do not have the same balance sheet buffers are severe. The Federal Reserve's response toolkit is available but limited. The standing repo facility can provide overnight liquidity. The discount window remains open for bank borrowing. The Fed can conduct emergency open market operations similar to those deployed in September 2019, and in extreme scenarios, the Fed could recreate a facility similar to the Bank Term Funding Program that was deployed in March 2023. But each of these tools has been deployed before, and each has political constraints on its usage. Reopening the BTFP would be acknowledgement of a banking crisis. Large-scale open market operations would add to the Fed's balance sheet at a time when inflation is already above target. Aggressive SRF usage would signal that the system cannot function without the Fed's direct intervention in overnight markets. None of these are actions the Fed wants to take. All of them become likely if the tax drain produces more stress than the system can absorb. Notably, a regulatory change that took effect on April 1st may provide a small offset. The revision to the supplementary leverage ratio requirements gives the largest banks more capacity to buy treasuries and engage in repo. ING's analysis suggested this could be a meaningful benefit to market functioning. The impact depends on how much of the available capacity banks choose to deploy. Banks that are conserving balance sheet flexibility for their own credit exposures may not use the regulatory relief to expand their repo activity. The net effect of the rule change on actual market liquidity will be revealed over the coming weeks. Now, let me connect this to your bank account specifically because the post-tax liquidity trap does not just affect Wall Street traders and money market fund managers. It affects every household whose money sits in the banking system. The first dimension is deposit availability. In a normal liquidity environment, your bank has ample reserves to process any withdrawal request immediately. In a tight liquidity environment, banks may begin extending hold periods on large deposits, limiting daily wire transfer amounts, and imposing identity verification procedures on transactions that previously processed automatically. These are not dramatic measures. They are the quiet adjustments that banks make when their liquidity cushions shrink. You may not notice them unless you attempt a large transaction. But the cumulative effect across the banking system is that the frictionless access to cash that Americans have come to expect degrades at the margin. The second dimension is deposit rates. When banks need to attract or retain deposits in a tight liquidity environment, they raise the rates they pay on savings accounts, money market accounts, and certificates of deposit. The flip side is that banks also raise the rates they charge on loans, including credit cards, auto loans, personal loans, and business lines of credit. The consumer who is already carrying $1.28 trillion in credit card debt at 22% interest may see rates rise further. The small business owner whose line of credit resets quarterly may see borrowing costs increase. The household planning to finance a vehicle purchase may discover that auto loan rates are higher than they were when the year began. Each of these micro adjustments is a tax on the household extracted by the tightening of the financial system. The third dimension is the regional bank vulnerability. The megabanks, JP Morgan, Bank of America, Wells Fargo, Citigroup, have balance sheets that can absorb substantial liquidity. Shocks. The regional banks that hold the majority of commercial real estate loans and a disproportionate share of unrealized losses do not have the same flexibility. If the post-tax liquidity environment pressures any of the 60 institutions currently on the FDIC problem list, the depositors at those institutions face the prospect of an FDIC resolution. The FDIC insures deposits up to $250,000 per depositor per ownership category. Deposits above that threshold are subject to the resolution process, which in recent years has produced outcomes ranging from full protection at SVB to partial haircuts in other scenarios. If your deposits exceed the FDIC insurance limit at any institution, the post-tax environment is the moment to verify your coverage and diversify across multiple institutions if necessary. The fourth dimension is the private credit and money market fund exposure. Funds that invest in commercial paper, repo transactions, and short-term corporate debt are directly affected by funding market conditions. In a September 2019 Style episode, some funds could experience redemption restrictions or net asset value adjustments. The BlackRock Gate, the Blackstone Capital Injection, the Blue Owl IOUs, and the Morgan Stanley redemption cap that were all activated earlier this year demonstrated that private credit funds are willing to gate investor access during periods of stress. If the tax drain produces the funding pressure that the drained reverse repo facility suggests is plausible, additional gates may be activated. So what do you do over the coming week? First, verify your FDIC insurance coverage. For any bank account exceeding $250,000, understand exactly how much of the balance is covered and how much is not. Spread deposits across multiple institutions if necessary. Use different ownership categories, individual, joint, trust, retirement, to maximize coverage per institution. Second, monitor the SOFR to IORB spread and the standing repo facility usage daily this week. These are publicly available data on the New York Fed website. If the spread widens significantly or SRF usage surges, the funding stress is manifesting and additional defensive positioning may be warranted. Third, ensure adequate liquidity outside the banking system. This does not mean withdrawing all your money from banks. It means maintaining enough cash in physical form and in direct Treasury holdings that you have access to funds regardless of any short-term disruption at any individual institution. Physical cash for emergency expenses. Treasury bills held directly through Treasury Direct, or brokerage for the bulk of short-term savings. Bank deposits for transactional needs, but not for all of your liquid reserves. Fourth, avoid initiating large transactions during the peak liquidity stress window. Between April 16th and roughly April 23rd, the tax drain will be most active. Wire transfers, large deposits, and major transactions may experience delays or enhanced verification requirements. Planning ahead and completing major transactions before or after this window reduces the risk of disruption. Fifth, consider the broader portfolio implications. Long-duration bonds are the most vulnerable to rising Treasury yields. If foreign selling continues and the tax drain produces additional upward pressure on yields, long-duration positions will absorb the losses. Short-duration Treasury bills are the Buffett-style positioning that benefits from rising yields as each maturing bill is reinvested at the new, higher rate. This is why $373 billion of Berkshire Hathaway's balance sheet sits in short-duration Treasury securities. The positioning is specifically designed for an environment of elevated and rising short-term rates, which is exactly the environment the post-tax liquidity trap would produce. Here is the truth that connects the tax payments of April 15th to every dollar in the American financial system over the next 7 to 14 days. The Treasury General Account is going to rise toward its projected peak of $1,025 billion. Bank reserves are going to fall by a corresponding amount. The reverse repo facility that absorbed these drains in previous cycles is empty. The Federal Reserve's backstop tools are available but politically constrained. The banking system is carrying $306 billion in unrealized losses. The Iran war has added an oil shock that exceeds $100 per barrel. Japanese institutions have reduced their purchases of American Treasury debt. Private credit funds have activated gates. Commercial real estate is facing its maturity wall. Consumer credit is at record stress. And the bank earnings that just reported over April 13th through 15th will reveal the condition of the American financial system at the exact moment when the liquidity drain is hitting its peak. The September 2019 episode happened in a much healthier environment than the one that exists today. The reverse repo facility was available. Bank reserves were closer to the ample threshold. The macroeconomic backdrop was not a stagflationary oil shock. And yet, even in that much healthier environment, a corporate tax drain plus Treasury settlements produced a funding market seizure that required emergency Fed intervention to resolve. The conditions in April 2026 are structurally worse in every dimension. The post-tax liquidity trap is not a prediction. It is the mechanical consequence of cash movements that are already occurring. The payments submitted on April 15th are clearing. The reserves are draining. The TGA is rising. The repo markets are tightening, and the banking system is being tested against conditions that the Fed's own research publications have flagged as requiring continued close monitoring. The institutions understand this. Warren Buffett's $373 billion in Treasury bills is positioned precisely to benefit from rising short-term rates and to be immune from the funding stress that affects longer duration instruments. The Bank of America Fund Manager Survey, showing cash allocations at pandemic-level highs, reflects the same understanding. The institutional rotation into defensive positioning has been happening for months. The retail investors who remain in the positions that the liquidity environment is about to pressure are making a bet that the Fed will step in before the damage reaches their accounts. The Fed may step in. It also may not step in fast enough. It also may step in with tools that are less effective than they were in previous cycles because the constraints are tighter now. Your money is most protected when it is positioned to survive the scenario that the institutional investors have been preparing for. Adequate FDIC coverage. Treasury bills held directly rather than through intermediaries, physical cash reserves for immediate liquidity, diversification across multiple institutions, an awareness that the quiet week following tax day is often the most dangerous week in the banking calendar because the stress that was predictable becomes actual. The tax payments have been made, the drain has begun, the reverse repo cushion is gone, the Fed is watching, and the American banking system is about to demonstrate whether its cushions are adequate to absorb the largest projected liquidity drain in recent years, overlaid on the most fragile macroeconomic conditions since 2023. The data will reveal the answer over the coming days. The SOFR spread will tell you. The SRF usage will tell you. The regional bank stock prices will tell you. The deposit flow reports will tell you. And by the time the answer is visible to every retail investor through the headlines on financial television, the time to have positioned will have passed. The positioning happens now, in the quiet days between the tax deadline and the Fed's next FOMC meeting on April 28th and 29th, while the drain is working through the system and the early indicators are appearing for those who know where to look. The post-tax liquidity trap is the mechanical consequence of a simple arithmetic. $400 billion extracted from the banking system. Zero buffer in the reverse repo facility. $306 billion in unrealized losses already sitting on bank balance sheets. 60 banks on the FDIC problem list. An oil shock compounding every other pressure. And a Federal Reserve that is preparing to use emergency tools that it has explicitly flagged as ready for deployment, but that carry political and economic consequences when activated. The arithmetic is not negotiable. The question is whether the system absorbs the drain through orderly adjustments in funding rates and bank balance sheet management, or whether the drain overwhelms the available capacity and triggers the kind of emergency response that transforms a routine seasonal event into a defining moment for the 2026 financial landscape. The evidence suggests the latter is plausible. The conditions suggest the latter is dangerous, and the positioning required to survive the latter is available to anyone who acts on the information before the information becomes action. Check your deposit coverage, hold direct treasuries, maintain cash reserves, avoid gated investment vehicles, monitor the funding market indicators, and understand that the week following tax day every year is when the banking system's vulnerabilities are most exposed, and that this year, more than any year since 2023, those vulnerabilities are positioned to produce consequences that extend far beyond a temporary repo rate disruption. The drain is happening. The clock is running. And the quiet, invisible flow of dollars from your bank's reserve account into the Treasury general account at the Federal Reserve is the single most important financial event of the month, even though almost no one in the financial media will discuss it until after its consequences have already reshaped the week that follows. And let me give you the deeper historical context that reveals why the 2019 repo spike has become the most referenced event in every conversation about post-tax liquidity dynamics. Because understanding what happened in those specific hours reveals how fast a funding market can transition from functioning to frozen. On Monday, September 16th, 2019, the secured overnight financing rate opened at approximately 2.1%, roughly in line with the Federal Reserve's target range. By Tuesday morning, September 17th, SOFR had surged above 5%. Intraday trades in the repo market occurred at rates as high as 10%. Banks that had routinely funded their Treasury positions at 2% overnight suddenly faced the prospect of paying 5 times that cost. The Federal Reserve, which had not conducted open market operations in a decade, was forced to inject $53 billion in emergency liquidity on Tuesday. On Wednesday, it injected another $75 billion. On Thursday, another $75 billion. On Friday, another $75 billion. Over the course of the week, The Fed injected approximately $270 billion into the system to restore normal functioning. The root cause was a combination of corporate tax payments on September 16th and a large Treasury settlement on September 17th that together drained reserves below the threshold the market required. What made 2019 so instructive was the speed of the transition. The market had been functioning normally on Monday morning. By Tuesday morning, it was broken. The warning signs had been accumulating for weeks as the Federal Reserve's balance sheet runoff had reduced reserves gradually, but the actual failure happened in hours, not days. The difference between preparation and surprise was measured in hundreds of millions of dollars across the institutions most affected. The 2026 conditions make the 2019 precedent both more relevant and potentially more severe. In 2019, the reverse repo facility held several $100 billion that could theoretically have been deployed to provide liquidity. In 2026, that buffer is zero. In 2019, the Federal Reserve had plenty of balance sheet capacity to inject liquidity without political constraints. In 2026, any large-scale Fed intervention will be interpreted in the context of the ongoing debate about whether the Fed is cutting rates to support the economy or being forced to support financial stability at the cost of its inflation-fighting credibility. In 2019, there was no Iran war, no $100 oil, no stagflationary backdrop, and no $306 billion in unrealized bank losses. The bank earnings from the past 3 days provide additional context for what the post-tax environment will look like. J.P. Morgan's report on April 14th revealed the condition of the largest and most diversified bank in America. The metrics that matter for the liquidity environment are the ones that do not make the headlines. Net interest income, deposit costs, loan loss provisions, commercial real estate reserves, consumer credit delinquencies. If J.P. Morgan is building provisions, raising deposit rates aggressively to retain funding, or flagging deterioration in any major loan category, the implications for the smaller institutions that compete in the same markets are severe. Wells Fargo's commercial property lending book is among the largest in the industry, making its reserve building against commercial real estate loans a direct signal that the 2026 maturity wall is producing defaults. Citigroup's credit card portfolio delinquency trends are the most direct indicator of consumer financial stress. Bank of America's commentary on consumer deposits reveals where American household cash is flowing. Morgan Stanley's wealth management commentary provides insight into high net worth household behavior. And Goldman Sachs, which reported April 13th, designated this earnings cycle as the definitive litmus test for the financial system, a framing that institutions do not use lightly. Now, let me address what the broader market signals are telling you alongside the specific liquidity dynamics. The S&P 500 has been trading in a wide range around 7,000. Treasury yields are elevated at 4.25% on the 10-year and approaching 5% on the 30-year. The dollar index has been volatile. Gold remains near record highs at approximately $4,700 per ounce. Oil is above $100 on Brent and WTI. The VIX has been elevated but not panicked. The credit spreads on high-yield bonds have widened modestly. And the flow into money market funds has been consistent with a risk-off environment as investors seek safety in short-duration instruments. Each of these signals alone could be interpreted as consistent with a normal adjustment in a market that is repricing for slower growth and higher inflation. Taken together, they form a coherent picture of a market that is positioning for a meaningful deterioration in the underlying economic environment. The institutional positioning that I have referenced throughout this analysis, Warren Buffett's $373 billion, the Bank of America Fund Manager Survey, the private credit gates, the defensive sector rotation, all of these are responses to conditions that have been building for months. The post-tax liquidity trap is not the first signal of stress. It is potentially the trigger that converts accumulated stress into acute dysfunction. And the asymmetry of outcomes is what makes the defensive positioning so compelling. If the system absorbs the drain without incident, defensive positioning produces modestly lower returns than risk-on positioning would have generated. If the system fails to absorb the drain, defensive positioning protects capital that would otherwise be damaged severely. The calculation that favors defense in this environment is not a market timing bet. It is a recognition that the reward for being wrong about stability is low, and the penalty for being wrong about stress is high. Under those conditions, the rational allocation is toward defense. That is what Buffett has done. That is what the institutional fund managers have done. And that is what the retail investor who understands the mechanics of the post-tax environment should consider doing at whatever level of defensive positioning is appropriate for their specific circumstances. The week after tax day has always been the most stressed week of the banking calendar. In 2026, the structural conditions surrounding that week are more challenging than at any point in the post-2019 period. The mechanical drain is happening. The buffers that used to absorb it are gone. The macroeconomic conditions are stagflationary. The geopolitical backdrop includes an active war. The bank balance sheets are carrying historic unrealized losses, and the Federal Reserve is constrained by a policy environment that limits how aggressively it can respond without worsening the inflation problem that is already above target. Your money sits at the intersection of all of these dynamics. The deposit you have in your checking account is supported by your bank's reserve account at the Federal Reserve. That reserve account is smaller today than it was yesterday because of the tax payments that cleared overnight. It will be smaller still tomorrow, and by the end of next week, it may be approaching levels that historical precedent suggests produce funding market stress. You do not need to panic about this. You do need to understand it, position for it, and verify that your financial arrangements are structured to survive whatever stress emerges over the coming days.